This webinar was recorded live and we covered a lot of different topics, specifically price action. We showed the trade scalper signals live, the Atlas line signals live as they happen in front of everyone. If you have any questions, email support@DayTradeToWin.com. If you like what you learn here at our YouTube channel, remember to subscribe to the YouTube channel, DayTradeToWin, and I'll see you at the next mentorship class starting June 2nd, 2020. Good morning, everyone. Wes, Tony, Ron, Mo, Diane, Chris, Bob, Bill, Bobby, Al. All right, let me know if everybody can hear me. Nice crowd today in the room. So let me add here a few of the indicators to the chart. The indicators are the DayTradeToWin indicators. Answer your questions. I'm going to show you the software in action as well. Let me take a quick look here. Take a look at the trade scalper. And I'm going to remove here the roadmap. Roadmap is one of the methods that we teach in the mentorship program. I'm going to remove that. I'm just going to focus on the trade scalper for right now. Okay. All right. So what we have here as a trader, I want to look at an opportunity to buy or to sell the market. For those of you who are new, we're looking at the E-mini S&P. The candles and the bars that you see here on the chart are 1 minute candles. So every candle is 1 minute. One thing that I do recommend everyone to add to your chart is a bar timer. So I'll add a bar timer here to the chart. And that way it's a countdown timer. How many minutes or seconds are left if you're looking at a 5-minute chart or a 1-minute chart or a 30-second chart. And so if there's a entry or if there's a trade and I know that I have to wait until the candle closes before I buy or to sell, I can have an advanced warning by using the bar timer. So that's something I recommend. I also recommend that you use here the crosshair instead of being a arrow, which doesn't really help me. I recommend everyone use the crosshair, either local or global. That way I can see exactly the price as well as the time, which is very important anywhere I put the cursor here on the chart. Before we begin, a disclaimer on the risks involved with trading. Remember, trading is risky. Please don't trade with funds you can't afford to lose. Talk to your broker. Just understand that trading is not for everyone and you can make a lot of money, obviously, but you can also lose a lot of money. So just remember there's risks involved with trading. This webinar is not pre-recorded, it's live. So if you guys have questions and if you would like to see something or ask a specific question of me, I'm happy to answer it. So this is a live presentation. It's not a pre-recorded presentation, as many presentations are pre-recorded. This is not a pre-recorded presentation. Okay, so the trade scalper is what most traders start off with. Then they move or they graduate into the mentorship or to another software like the Atlas line or the At the Open. The trade scalper provides a lot of signals, and there are a few rules that we have to make sure that we look at before jumping in. So the first is to know the current market conditions. I refer to this all the time, what's expected of the market. And so I can see that the market's moving at about 2 points, which means the last 4 candles on the E-mini S&P have traded for a distance of 2 points, and I can expect the same moving forward. So if there's a signal to go short, just remember 2 points, 1.5 points, 1 point, 3 ticks, it's all doable. But what's not available to you as far as a distance for profit is, let's say, 3 points or 4 points, unless you trail a stop, unless you hold on to the trade with some type of trailing stop model. But as far as the distance, just refer to the ATR and be a little bit more conservative. There's nothing wrong with taking 8 ticks instead of 9. So this here, the scale is based off of points, but the smallest increment any move on any market could make is referred to a tick. In currencies, it's referred to a pip, and this happens to be $12.50 every tick or every time it moves. So this is 0.25, quarter point equals $12.50. Every point is 4 ticks, so 1 point is $50. So that gives you a reference point of the kind of money that you can make or you could lose as well, the risk involved, how your profit targets affect your trading account as well. Nowadays, with the volatility being the way it is, check with your broker to make sure that they have not increased the margin. And typically, margin for every E-mini or a mini contract is probably $500 to $1,000. For micro E-minis, even smaller, you can trade with less money. So you don't need thousands and thousands and thousands of dollars to open up an account. You just have to make sure you abide by the margin. And I also think it's good to have a little bit more than just margin money. Okay, so margin money is to keep you in the trade, have a little bit of a buffer there in case you get stopped out and you want to trade again. And that way you're always able to continue and recover. So one thing here that I see is the market is dropping and going lower and lower and lower. But it doesn't necessarily mean that this will continue lower. You're going to see that markets don't often uh, move in a trend and continue in a trend for long periods of time. And by the time you look at a moving average crossover or an MACD or all of the indicators that most traders are trying to make heads or tails of, typically the move is over. So as the market is going down, finally your moving average crossovers or whatever type of indicator you may be looking at tell you to go short, and sometimes that's the at the end of the move. So let's not focus so much on the average indicator. Let's instead look at price and look at time and look at how the candles are moving and working to make our decisions. Because with indicators, there's always an optimization factor. And if anyone looks at optimizing specific values, it's just curve fitting data onto the chart. And that's not how we should trade. We shouldn't look at, because this moved in such a way and you curve fit or optimize the data that these specific values work, that it's always going to work. So instead, what I want to do is I want to look at the wicks. I want to look at the bodies of the candles. I want to look at the pricing. I want to look at the ATR and the current conditions. I want to know if the market is too volatile or it's too slow. So on the E-mini S&P, whether it be a 1-minute chart or a 5-minute chart, nowadays we're looking more at a 1-minute chart because the volatility is so high. This would be between 1 and 5 points as the sweet spot to take trades. Anything above 5 points here, whether it be on a 5-minute chart or on what we're looking at a 1-minute chart, is really volatile and there's a lot of risk involved. And anything less than 1 point as well, I believe it becomes too much of a chop and the market is too slow and it's whipsawing up, down, up, down. All right, Bobby, can you hear me okay? A little bit better? Okay, so now what I'm looking at here is a potential to buy or to sell at the right moment. So look at what we're seeing. Look at the candles. I don't have any indicators on the chart that most of us look at. And what I see, and so this is just basic price action. What I'm explaining to you here is I see that the market came to this low over here. Right there, this price looks like about 1305.75. So here is what markets love to do, and you should start looking at this. Markets love to test where they've previously been. So if the market prefers to be in areas and in prices where it's already been, as opposed to moving into areas of unknown territory for the day or for the year, this to me tells me that there's a high likelihood that the market's going to want to test this. Now, it could go through it, it could test it and bounce off of it. All I know is that the market has traded to this price right here, and there's a high likelihood that the markets wants to come down and test this low. Now, in a simple term, that's called a double bottom or a double top, and it may or may not happen. But now that we know a little bit more about how price action works and what to expect, let's put some rules to it. And let's say I'm going to go short for this reason, or I'm going to go long for this reason. So if you go short, you're looking at going short because the market is testing where it's previously been. And very important, always try to get a better price or enter at a better price. If you try to enter at a price that is a bad fill or you're chasing the market, that's never going to work. So if I know that the market wants to test this low, it's much better to enter at a better price here, up here, as it comes back down to test where it's previously been. And so a lot of the methods that I teach are based off of first understanding where the market has been and then trying to enter at a better price and taking that in that same direction. Uh, Dan says here, do you play gap fill? I don't play the gap fill. I don't trade gaps. I just look at the markets as they're working, as they're operating, and the software. And the courses actually teach you the method. So it's not as if anything that we're looking at is black box and you're never going to understand how it works. I actually like to teach and show you the trades, why they're happening, to calculate them on your own. If you're not using NinjaTrader or if you're using a different charting platform, you can actually trade them on your own without the software. So I want to teach you something and how it works. Now I'm also going to add here the Atlas line. And there's also another way you could look at the trade scalper. I'm going to put up a 2-range chart here. And I'm going to look at the trade scalper here. Just a second. Because the 2-range chart allows for very fast entries in and out of the market. We don't need the ATR when looking at a range chart. And so this is a range chart, and this here would be a 1-minute chart. Now the differences between the two charts is one is based on time and the other one is based off of the movement. So a 2-range chart, let me just bring this out here. A 2-range chart here, over here, and this is 1 minute. This is every candle is based off of 2 ticks, so it's just distance. This here is time. So when the candle closes 1 minute, there's a recalculation. When the candle closes, there's a recalculation. This here is movement only, no basis off of time whatsoever. So if the market is moving, the signals are being generated on distance. This here allows you to do not just distance, but time. The candles have to close for the calculation to operate. So this signal, 3005.75 to go short, is a signal that was generated with a target of, I don't think more than 2 to 2.5 points here based on the ATR. 1305.75 is right here, like that. And so this is when this candle closes, this signal appears for you to go short. Now, if it's a very fast market and the market just takes off on you and you don't really have an opportunity to go to your dome or go to your chart trader and jump in, let it go. I don't want anybody to jump in and enter short here unnecessarily when you could have entered on this candle here or at the close of this candle. So really my goal is not for you to chase the market with bad fills. It's for you to understand why the signals are happening, make a decision whether you want to go short, know in advance, which is very important, that the signals are going to be triggered and going to occur. And that way, if you know what the ATR is, you can say, well, the ATR is at 2 points or 3 points. I know that a 2-point or 1 point or 2.5-point target is an option. If you hold on to a trade for too long, it's not in your benefit. So most of the time, I like to hold on to a trade If it's going in my favor, great. But if it's not going in my favor, it's break even or small win or small loss. Typically after 4 candles, I call that a time-based stop. It's time to exit the trade and look for the next trade. Okay. So from here to here, 5.5 points is not something that I would consider. I would consider instead at the time the ATR was about 2 3/4. So I would say a good 2.5, 2 point move is what you should be at least looking at as a scalper or as a quick in and quick out without holding on to the trade and being done with it. Anyone have any questions? All right, Diana, you're good. Bobby, Wes, Ron, Tony, Chris, Wes, Al, LB. All right. So the trade scalpers, what you're seeing here is just one of the methods that I teach. They're all different. For example, the at the open method is based off of the market opening and beginning to trade in a direction. So the market opens, whether it be the London session or the US session, or it could be any market really, the Asian session. And as soon as the market opens, it begins to move up or it begins to move down. From that point, the at the open method begins to calculate and says, well, if the market is going up, I can do something with that long trade. If the market goes down, I can do something with that short trade. And typically it's just one trade per day on the at the open method. The trade scalper, as you can see here, has a lot of signals. And not that you want to take every signal. I don't think that trading right as the market opens or trading right as the session is about to close, or even some overnight or Globex situations, I don't think that's the right way to go when trading overnight because sometimes the market is too slow or during news events. So obviously you have to use a little common sense as a trader not to throw yourself into a situation where you're placing a trade at the worst time. You should place the trades when there's nothing that's going to conflict with what you're doing, and that would be the time of day, during a news event, when the market's too slow or too volatile. Jay here asks, can you explain what the 5 point scale represents again? Sure. So this scale down here, Jay, the ATR down here, the average true range, the ATR is based off of the last 4 candles that have plotted. So currently I'm looking at a 1 minute chart. So the 1 minute chart, the last 4 candles that have plotted are these 4 candles. So what it does is it takes, and you can do this in any market, as long as it's a minute chart. So 1 minute, 5 minute, 10 minutes, 60 minutes, all the same daily. It takes the high to low from each of these 4 candles, divides by 4, and says the last 4 candles, in this case, the last 4 minutes, have traded from high to low on average 3.25 points. Now, 3.25 points over here would be roughly, if you multiplied or divided, about 12, 13 ticks, 12, 13 ticks. So, or 3 points. So if you're looking at 97 to 3000 or 97 to 94. So the distance that this candle is going to move is going to be pretty much equal to the ATR of the last 4 candles. So that's what the scale is representing. It's representing the distance. Some markets are in points, other markets are in ticks. The currencies, for example, are in hundreds. Some markets are in tenths, but it's really all the same. It's not that difficult to understand what it's saying. It's saying that the last 4 candles have moved 3.5 points, which is now these 4 candles. And so this candle, you can expect it to move this distance. Now the distance could be up or the distance could be down. And so this doesn't tell you direction, Jay. So I'm not going to expect it to go down 3 points or up 3 points. It's just the range of the candle from high to low has that expectation. And why that's important, you got it, Jay, you're welcome. So why that's important is because if you enter into a trade and you're wondering what's the stop and what's the target and what can I expect out of the movement, this at least gives you a direction. I can expect the distance of this candle to be roughly 3.5, 3.75 of a point, which will then lead me to say what's my stop, what's my target, and so on. If you want to learn more about trading, visit DayTradeToWin.com.
Subscribe to the DayTradeToWin YouTube channel, the next mentorship class where we cover all of these methods with lifetime licenses for the software.